So great. So this particular lesson basically is to teach you how to do an income statement using absorption costing. There is what we call marginal costing or variable costing. And the marginal costing, as we shall be seeing later on, when it comes to valuing an inventory item, you only take variable production cost into a unit. But if it's absorption, you'll take both variable production costs and all fixed production costs into one unit. So today's agenda is to teach you how to do absorption costing. And here I have a question. Here I have a question that I would want to share with us. We are told XPLC produces desks. Each desk is budgeted to require 4 kilograms of wood at 3 per kilogram, 4 hours of labor at 2 per hour, and the variable production overheads of 5 per unit. Fixed production overheads are budgeted at 20,000 per month, and average production is estimated to be 10,000 units per month. The selling price is given there. There is also a variable selling cost of $1 per unit and a variable selling cost of $2,000 per month. During the first 2 months, XPLC expects the following levels of activities. So we have January, production is 11,000, sales is 9,000. If you look at January, we have produced 11,000 and we were only able to sell 9,000, meaning that the remainder of units will go into what we call closing stock, closing inventory. So our closing inventory in that case for January will be 2,000 units, 2,000 units. So they want us, number one, to prepare a cost card using absorption costing. So number one here, they want me to prepare a cost card using absorption costing. So we are absorbing all production expenses, absorption costing. So to produce one desk, remember this is for one desk. This is for one desk like that. So we have our material cost. So our material cost, ladies and gentlemen, of course, this will be the wood. The wood in this case here that we have there, the wood which we need, they have told us it's 4 kilograms, each going for 3, which gives us dollars what here, somebody? 12. We also need labor cost. Labor cost, they have told me the number of hours we need to prepare to make each desk. They have told me the labor hours are 4 hours at 2 each. Labor hours, 4 at 2. So this is 4 hours at 2, which gives me 8 there. 4 hours at 2, which gives me 8. And then we have variable production cost. So we have here variable production cost, variable production overhead cost. So the variable production overhead cost, what have they told us about variable production overhead cost? So variable production overhead cost, ladies and gentlemen, the variable production overhead cost is 5 per unit. It's 5 per unit. It's 5 per unit. Variable production overhead is 5 per unit. It's 5 per unit. It's 5 per unit. Variable production overhead is 5 per unit. It's a production cost. It has to come into costing. And then we have the last one, which is the fixed production overhead cost. Fixed production overhead cost, what have they told us? Fixed production overhead cost, ladies and gentlemen, fixed production overhead cost, ladies and gentlemen, what they have told me here is fixed production overhead is 20,000 per month and average production is 10,000. So 20,000 divided by 10,000. So 20,000 divided by 10,000. So for fixed production overhead, they have told us for a whole month is 20,000. And for that whole month, we shall produce 10,000 desks. So divided by 10,000, because really we would want to get fixed production overhead cost per unit because it's per desk, which gives me 2. So could you kindly confirm how much are we getting? One thing you're supposed to appreciate as great students here is that our standard cost card only takes care of production expenses. Anything which is more than production, which takes more than production, which comes after production, like selling, etc., can never be charged into units. So they're telling me it is 27 like that. It's 27 like that. So the first one, we should have, ladies and gentlemen, gotten it correct, all of us, which is okay. Now, from there, we go to part B of the question. So part B of the question, they want me to set out a budget profit statement for the months of January and February. So I will do an income statement for January 1st. So income statement for January. So mention there, income statement for January. And how do we really get our income statement? To get our income statement is a straightforward thing. We normally take sales less cost of sales to get gross profit first. So we have, ladies and gentlemen, here, we have our income statement using absorption costing. The title is there. So we start with the month of January. So we start with sales. So sales for January, you are the ones who told me that we sold 9,000 units, and each unit from this question, each unit is costing how much? 9,000 units, and each unit is costing how much? Each unit is selling at 35. The selling price is 35. So times 35. So 9,000 times 35. So 9,000 times 35. Are you able to give me this figure, ladies and gentlemen? 9,000 times 35. 9,000 times 35. So we have here 315,000. 315,000. 315,000. So from there will come under less cost of sales. So we less cost of sales. Where cost of sales, if you can remember, we normally start with opening stock. Opening stock. In this particular question, there is no opening stock. We come and add what here? Purchases, but remember these are production farm. So we add production cost. And it's not lost on me that these guys produced 11,000 units. 11,000 units. So add production. So production, we have material cost. How much did it cost us to produce this 11,000? We have labor cost. Labor cost. We have, in this case here, variable production cost. And then we have the fixed production cost. So the material cost from the standard card that we have, which told us, of course, we have 4 kilograms of wood times 3. So the material cost per unit here is 12. The labor cost per unit, what do we have? Labor cost, it was 4 hours at 2. So this gave us 8 per unit. And then we have variable production overhead, which gave us 5. And then we have a fixed production overhead, ladies and gentlemen, gave us what here? 2. Fixed production overhead gave us 2. Fixed production overhead gave us 2. Moses has raised up his hand, which is very good. Yes, Moses. Moses, let me give you, thank you so much. Moses, are you able to unmute yourself, or you type your answer, your question, I mean? Moses, because I can see you're not muted. Is it possible? Is it possible you type? Is it possible you type? Is it possible you type? Okay, so we continue, ladies and gentlemen. So in this case here, we had the material cost of 12, labor cost of 8, variable production of 5, fixed production cost per unit is 2. So please come and multiply these with the number of units here you produced in the period. And you did produce 11,000. You did produce 11,000 like that. You did produce 11,000 all through. So this one here, could you kindly give me these figures now? You don't want to miss out on anything. You don't want to miss out on anything. You don't want to miss out on anything. So 12 times 11,000. 12 times 11,000. 132,000, right? So we have here 132,000, 132,000. And then we have 8 times 11,000. This is easy, 88,000. Then we have 5 times 11,000. This is 55,000. Then we have 2 times 11,000. This is 22,000. So is there somebody who can add for me everything here? Please add for us everything there, everything to give us, in this case here, basically the total value of goods which are available for sale. So is there somebody who can add for us? Please add for us. It is giving us 242,000. Are you sure? 242,000. Could you kindly try 297,000? Please try to ensure that somebody give me the correct figure. You don't want to repeat this again. Don't want to repeat this again. You don't want to repeat this again. The people are waiting for these videos. 297,000, right? So 297,000. And then now you come and you less closing stock. You less closing stock. Closing stock here, you are the ones who told me that closing stock, we produced 11,000 units. We produced 11,000 units and sold only 9,000. So you must be having 2,000 which were not sold. So less closing stock. So the closing stock here is 2,000. The closing stock is 2,000. And remember, as I told you, closing stock is always valued at the standard cost card value. That standard cost card value, total figure for the standard cost card. In this particular case, if I'm not wrong, it gave us 27. So what is 2,000 times 27? What is 2,000 times 27? 2,000 times 27. 2,000 times 27. 2,000 times 27. 2,000 times 27. I'm really depending on you for correct figures. 2,000 times 27. Is there somebody who is able to see 54,000? Thank you so much. So please subtract here to give us what we call the gross profit. Please subtract there to give us what we call the gross profit. Give us the gross profit. 243,000. Is there somebody who has a different figure? 243,000. Remember that this gross profit is unadjusted. It is unadjusted. It must be adjusted for what year? It must be adjusted. It must be adjusted. It must be adjusted. It must be adjusted for any over or under. Over or under. So come here and do the adjustment. So then I would want to come here and see whether there was over or under absorption. So talk over absorption difference. So the absorption difference, I look at the absorbed overheads minus the actual overhead. Absorbed overhead minus the actual or budgeted, one and the same. So into my production, I absorbed, remember this is absorbed, it's in terms of fixed production only, fixed production overhead only. So you can see here we absorbed the fixed production that we absorbed here was 22,000. And then when you check the actual or the budgeted overhead in our, or the budgeted overhead for a month is 20,000. So you take 22,000 minus 20,000. So then this will give us a difference of how much? A difference of 2,000 bob. I can see the absorbed is more than the actual. This is what we call over absorption. So this is 2,000 over absorbed. And when you over absorb an expense, it means that your income is understated. So the profit that you have here has been underdeclared, understated. Just like, for example, today, if you would want to cheat KRA, although it's bad to cheat KRA, what do you do as a business? You overstate your expenses for the income to reduce. So this one, by being overstated, automatically the income is understated. So to make good, you add over absorbed. So add over absorbed. So you add over absorbed fixed overhead of 2,000. So what you also can do to remember this is that whenever this figure you're getting here, so long as you follow this absorbed minus actual, whenever you get this figure as positive, the easier way is for you to come and do what here? Just add back. You add back. So Eric, try to write questions. Try to write your questions down. Try to write your questions down, please. Gross profit, I'm being told, is 72,000. Gross profit is 72,000. Aha, I know. Great. I know. I think the speed is quite high. We shall overcome. Thank you very much for saying this. That these students here, upon getting, sorry for this, upon getting, in this case here, upon getting this less closing stock, they got, in this case here, cost of sales of 243,000. This is your cost of sales, 243,000. So you take 315,000 minus 243,000. What are we getting here for our gross profit? What are we getting here for our gross profit? So our gross profit is the one they are telling me is 72,000, which is what here, which is unadjusted, which is unadjusted. So the gross profit here is 72,000, which is what here, somebody unadjusted. So let's come and adjust this for this over absorbed. So in this case here, add over absorbed, add over absorbed fixed production overhead, which you guys have given me a figure of 2,000. So then could you kindly give me the adjusted? Give me now the adjusted gross profit. So adjusted gross profit, what do we have, ladies and gentlemen? I would want to depend on you now very fast. The adjusted gross profit. The adjusted gross profit, what do we have here? 72 plus 2,000 gives me what figure? 72,000 plus 2,000 gives me what figure, somebody? Gives me what figure, somebody? 72,000 plus 2,000, it's quite easy. That's why they don't want to tell me the figure, right? That's why they don't want to tell me the figure. So we continue. We can see here that the adjusted gross profit is 74,000. So are we together up to here? Is this figure correct? Is this figure correct? Is this figure correct? Somebody, is the figure correct here? Is the figure correct? Is the figure correct? Is the figure correct? Is the figure correct? Yes, thank you so much. Now from there, we think of post-production. So post-production, we endeavor straight away to get into this journey where we start selling these products. So come straight away here and less selling. So we less selling costs. So we less selling costs, ladies and gentlemen, selling costs. We less selling costs. The selling cost, I can see them here. We have the variable selling cost of $1. Selling cost will always be multiplied with number of units here we sell. Selling cost will always be multiplied with the number of units we sell because it's our selling function. So we have the variable selling. So we have the variable selling. We have the variable selling. So the variable selling will be $1 times 9,000. So 1 times 9,000, this gives me 9,000 bob, like that. And then we have the fixed selling. We have the fixed selling. So the fixed selling, ladies and gentlemen, they have told us in this question, the fixed selling, they have told us in this question that the fixed selling is what here? The fixed selling is 2,000 a month. Fixed selling is 2,000 a month. So 2,000 like that. So please subtract. You'll be able to give us profit. You'll be able to give us the net profit. So net profit, take this minus this minus this. Please give me an answer. 74,000 minus this. Please give me an answer. $63,000. Thank you very much. Now, if you allow me, I would want us to race through the month of February before my next class, please let us race through the month of February to the end. And I would want to make use of what here? The same statement. The same statement, the same statement. I would want to make use of the same statement. I would want to make use of the same statement to do the month of February. To do the month of February. To do the month of February, I would want to make use of the same statement like that. So we start with February here. Great. Now for February, is there somebody who is able to see the number of units that we sold in the month of February? Number of units is sold in the month of February. Number of units is sold in the month of February. Are you able to see 11,500? So we sold 11,500 here. 11,500 times the selling price is fixed at 35. So could you kindly give me the dollars there, somebody? In February, you can see here February sales. February sales were 11,500. So could you kindly give me this? So 11,500 times 35, that will give us what figure, somebody? $402,500. Thank you so much. $402,500. Thank you so much. So here, do we have any opening stock in the month of February? In the month of February, do we have? I hope you guys will be able to do this and put February then. This is now January then. January. So February, is there somebody who can see? You know, closing stock of January. Closing stock of January becomes opening stock in February. Great. So here we have 2,000 at what valuation? At what valuation? Remember, we have our standard cost card for valuing stocks. Each unit of stock is normally valued at 27. So could you kindly give me this figure? Itakuja ikuwe ngapi, somebody? 2,000 times 27. 2,000 times 27 gives me what figure? Gives me what figure? 2,000 times 27 gives me 54,000. Thank you very much. Now from there, we come under account for production cost. Production cost, remember here, we produced, how many units do we produce in the month of February? Here, we produced how many units now in the month of February? If you look at this book very well, the production was 9,500. So production here is 9,500. We produced 9,500. We produced 95. So in terms of, for example, material cost, the 12 still stands. So I'll talk of 12 times 9,500. 12 times 9,500. Could you kindly give me a figure there? So all these things will remain, like material will be 8, or we have variable overheads of 5. We have production overhead of 2. So you're only changing the quantity here, 9,500, 9,500, 9,500. So could you kindly, ladies and gentlemen, then help me out here? Kindly help me out. Please give me these figures. So the first one I'm being told is 114,000. The first one here is 114,000. The second one will be 8 times 9,500. The second one will be 8 times 9,500. 8 times 9,500. 8 times 9,500. Is there somebody who is able to give me this figure? How I wish you could give me these figures very fast. 76,000. 76,000. Thank you so much. Then we have a 5 times 9,500. 5 times 9,500. 5 times 9,500. 5 times 9,500. 47,500. 47,500. 47,500. And then we have 2 times 9,500. 2 times 9,500. 2 times 9,500, which gives me 19,000. Thank you so much. Thank you so much. So if you wish, you can come and add this to get cost of goods available. Cost of goods available for sale, that's opening stock and all these, to get cost of goods available for sale. Is there somebody who is able to give us the cost of goods available for sale? If you add this plus this plus this plus this plus this, cost of goods available for sale. Don't add sales. It's only opening stock plus production. Opening stock plus production. Opening stock plus production. Is there somebody who can give me the cost of goods? Cost of goods available for sale. Cost of goods available for sale. 310,500. 310, 500. So come and less, in this case here, closing stock. Who can give me the closing stock this time round here? Remember here we produced 95, not 95,000, 9,500 only. Is there anybody who is able to see the closing stock in this question? The closing stock in this question. MM tells me 0. MM tells me 0. The closing stock in this question, she is right. He or she is right. Why? Because she's seen that we began the period with how many units here brought forward? We had the 2,000 brought forward. And then we produced ourselves 9,500, which gives us 11,500. But we ended up selling 11,500. So it means that we had nothing for closing. So closing here is 0. Closing is 0. Closing is 0. So when you subtract like this, then automatically you'll be able to get the cost of goods available for sale as 310, 500. So could you kindly subtract this cost of goods available for sale from the sales figure there for you to give me the unadjusted gross profit? Unadjusted gross profit. Unadjusted gross profit from Eric Surima, it is 92,000. Unadjusted. Remember, the good thing with you guys is that you have this book with you and the answers are given at the back. The answers of these questions are given at the back there. So we have here an unadjusted gross profit. I haven't gotten this from another student. Gross profit, unadjusted gross profit. Is there any other student who is able to prove that for sure this is 92,000? Any other student who is able to get that figure? Any other student who is able to get that figure? Please give me the figures. My class is supposed to start in 3 minutes. 92,000. Thank you so much. Now from there, ladies and gentlemen, I'm concerned with the adjustment. I'm concerned with the over stroke under. Over stroke what here? Under. So remember here, I need to come and look at the adjustment. So I'll look at the absorbed overhead minus the actual overhead. So this time round, we absorbed 19,000. The absorption is 19,000. Remember, it's fixed overhead alone, isn't it? Fixed overhead alone. Minus our actual still stands at 20,000. Actual doesn't keep on fluctuating. So that gives me automatically minus what here? Minus 1,000. If I get a minus and I followed this pattern, I need to come and subtract that 1,000 here. So you'll say here, less, under absorbed. When it's negative, we call it under absorbed. Less under absorbed. So in this case here, what is our adjusted gross profit? 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 Somebody talk to me. 93. 91. Should be 91. Don't add 91,000 because here we are subtracting. So after we get this, straight away now we go to the selling costs, of which we have the variable selling cost, variable selling cost versus fixed selling cost. So we have the variable selling cost versus the fixed selling cost. So the variable selling cost, what do we have here? So for variable selling cost, I know it's 1 per unit. So times number of units that we sold, which were 11,500. So 1 times 11,500. So we have here 1 for variable. 1 times 11,500, which will end up giving us 11,500. Fixed selling, this has been defined for us as 2,000 every month. 2,000 every month. So then could you kindly, in this case here, give us our net profit for month number 2. Give us our net profit for month number 2. What are we going to get there? Somebody has the net profit for month number 2. Net profit for month number 2. $77,500. $77,500. So, ladies and gentlemen, remember you are getting these great classes here from RCM Online College, which is 100% virtual college. And I would want to take this opportunity to welcome all of you to really join us. This is the best style of learning. Remember, as an accountant, we are, ladies and gentlemen, required to work online most of the times. This world has become a global village online. You're here working for a company in the US. So really, all of us are being called upon to be so nice, to be so good in terms of our computing skills. We must be good, right? With this teleconferencing. So the earlier we start adapting to these real dictates of life, the better. So I call upon all of you to ensure that you shun away from all physical classes, adopt online classes, and we shall be able to see places. So we've come to the end of this particular session. It's my hope that you guys enjoyed this particular class. Thank you so much, and bye-bye.